Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from First Resource Bank. Before I introduce our speaker, a few points to note. Please submit your questions in the question box at the left of the slides. If you are interested in scheduling a meeting with First Resource Bank, please click on the Meetings tab found in the left navigation bar. You'll be able to view the company's availability. Welcome, Glenn and Lauren.
Virtual Investor Conference, March 22nd, 2022. And as Matt said, Lauren Rinaldi, our president, will be joining me for this presentation. So let's get started. This is our forward-looking statement. Appreciate it if you take a couple of seconds to look at it. First Resource Bank was started in 2005 by Lauren and myself. We wanted a community bank in southeastern Pennsylvania. Early on, we concentrated on Chester County, but quickly evolved and working in Chester County, Montgomery County, and Delaware counties, which are all suburban Philadelphia locations to the west. We consider our primary market to be an hour away from our Exton location, which covers the whole Delaware Valley, parts of New Jersey, and northern Delaware. This picture in the insert is a picture of our Exton branch at night. We consider ourselves to be a hybrid community bank, which is the best of old school community banking with high touch branches, but adding on all the technology that's offered in the market by the large national players. So clearly, mobile banking, online banking are a huge part of this model that we have. We don't think you need to be on every street corner, but you do need to be available 24/7. And the insert there is a picture of our Westchester branch. Lauren's going to jump in here and talk about technology.
So part of the benefit of opening as a de novo bank in 2005 and operating as a single branch for our first 10 years is that we don't have the high cost branch infrastructure that can now be looked at as a liability for some of our peers. We implemented remote deposit capture back in 2007. Therefore, technology has always been in our DNA here at First Resource Bank. Providing this product for free has been our unique selling proposition since day one, and it's allowed us to keep our branch count low. Providing these services for free has been an absolute no-brainer for us, as the entire scanner network costs us less than 20% of the cost of a single physical branch on a monthly basis. We brand this service as FRED, First Resource Easy Deposit, and between this service and the mobile app, 66% of our daily deposits are received through these channels. Moving on to the next slide, the operating system that we had been running on since 2005 had become a bit dated, and it wasn't receiving the same level of enhancements as we would have liked to see. Therefore, we embarked on a full RFP process in mid-2019 to decide on what solution we wanted to commit to for the future before we added any more resources or bells and whistles to the existing platform. Now, COVID definitely got in the way timing-wise, but in July 2021, we completed a full core system conversion and are now committed to enhancing the customer experience through new add-on modules with this new core. We are utilizing proven, cost-effective technology solutions, not bleeding edge, but far more competitive than the solution we were on previously. We upgraded our digital banking platform in January 2022 as the next step in the process, and this new solution updates the look and feel of our digital banking by decades it feels. We're very excited about this platform going forward. Next steps in our enhancement plans include internal workflow automations, and this one is all about working smarter, not harder. Too many processes at the bank are still too manual, and building automated workflows to complete routine tasks will allow us to keep our FTE count low and focus employee time on higher level work. Business cash management. The online banking upgrade previously mentioned did not include online cash management services yet, but it's coming. We're waiting on this enhancement from our vendor, hopefully later this year. This is a very high priority item for us. Small business lending. We're exploring options to do small business lending online through a portal for lines of credit and other small business credit needs. The timing of this one is more fluid, but this is key to winning some deposit relationships, so we want to make sure that we can support those efforts in an efficient way. And deposit account opening. Every vendor does this well for consumer products, but we've yet to find one that can handle business accounts well because of the onerous beneficial ownership rules that are required by regulation. We plan to move forward with this solution once we have a solution that can handle business accounts well, since that's really at the core of our business. Moving on to our deposit markets. When you map out our 3 branch locations in Exton, Westchester, and Wayne, the area covered forms a triangle that holds over $16 billion of deposits. The Chester County market is robust with strong demographics, including a median household income of just over $104,000. Westchester is the county seat here in Chester County, and it has a booming business community, as does Exton. Our toehold into Delaware County with the Wayne branch was a logical next step for us, and that market holds similar demographics and is our official entry to the mainline market in suburban Philadelphia. To dive a little bit deeper into these markets on the next slide, I always say when you only have 3 physical locations, you better make sure that they're in the right locations, and we feel confident that we are in the right zip codes. Each of these markets has over $3 billion in deposits, so even a small market share translates into significant dollars. These markets are all well banked by the national players, and competition is high. We are seeing some of our competitors leave the market through acquisition, and they have been conspicuously absent from community events that they used to attend and sponsor regularly. This creates opportunities for us, and we want to make sure that we can capitalize on each and every one. We are known for wearing our First Resource Bank blue, or Smurf blue, and you can't miss our team when we cover an event as a result. Glenn and I are both wearing First Resource Bank blue today. Our goal is to have each branch at over $100 million in deposits within the first 5 years. The Exton and Westchester branches both met that goal and kept growing. Exton topped $200 million in deposits at June 30, 2021, and Westchester reached $162 million at that same date. Wayne opened in October 2019, and then we had to lock the doors 6 months later due to COVID, which had created some challenges to our growth in that market, but we remain committed to Wayne, and we have some interesting opportunities we're working on down there. Our entry to the main line was welcomed by the community, and we earned the Wayne Business Association Corporate Partner of the Year Award in 2021. And our team is getting back out into the community now that events are back in person again. We have a local merger happening in that market just about in our front yard, and we feel that there will be a sizable opportunity to grow on the main line as a result. So next we're going to talk about deposit growth. Total deposits grew 12% in 2021, but that was after growing 33% in 2020. And non-interest-bearing checking in particular had tremendous growth, where it increased 13% in 2021 after growing a whopping 97% in 2020. Growth on top of growth is exponential. This chart has a lot going on, but it tells a really important story of progress. The red, blue, and green bars show total deposit dollars by category, and the yellow line shows how much of total deposits were checking deposits. Historically, for many of our early years, we were raising deposits today to fund a loan that we did yesterday. That's the trend that you see in the 2011 to 2014 years in this chart. Checking balances represented only 6% of total deposits back in 2011. We didn't have the luxury of being picky about where the funding was coming from. We just needed money because we had a home for it in a loan, and we could price accordingly on the asset side to maintain our spread. We made a conscious decision in 2014 to fix the funding mix, and that started with opening our second branch in Westchester and staffing deposit business development officers in each location. You can see how successful those efforts were by following the yellow line on this chart. At December 31, 2021, checking deposits represented 36% of total deposits, a huge jump from 6% that it was at back in 2011. This reduced reliance on CDs and strong checking growth leaves us much better positioned for rising interest rates that have already begun. And now I'm going to hand it back to Glenn.
Thank you, Lauren. The next chart is on loan growth. Now, this excludes PPP. We had 26% growth year over year from 20 to 21 in that category. And clearly, the funding mix fix gave us a big advantage on being able to be more competitive on the loan side. We've typically been, last 8 years, we've had 13.7% growth on an annual basis. So 26 is a little bit above that, but we're going to grow the loan portfolio every year. That's what we're going to do. In 20, we clearly were busy with PPP, so that loan growth was a little stymied because we just didn't have enough time. The next slide is on PPP. So we did $83 million in PPP, 654 loans. We have one in repayment. That's a piece of it. Seasonal labor. If you were involved in PPP, you know some of that math was a little difficult at times. But the wonderful thing is the last two applications are in the forgiveness process right now. And just a side story, when we were doing this, and this was important work for every community bank that was involved, we had an employee of a company approach one of our directors in the grocery store to thank him for having us be involved in PPP because he had just gotten recalled back to work the next day. And it really touched a lot of families in this country. So we're thrilled to have been involved in that. The fees were nice too. We had $3 million in fees spread out over what will be 3 years. The numbers there in 2020 was 1.1, 21 was 1.7. And we think the balance of those 165,000 in fees will most likely be in the first quarter of 22. We're going to take a breath and we're going to look at the loan portfolio at 12/31. We are principally a business bank now. We used to have about a third of our portfolio in consumer, and that's not the case now. 2008 taught us anything that second wasn't a great place to be. And right now that part of the portfolio, that consumer other, which is at only 1%, is that non-first consumer loans, home equities. The 3% is consumer first, but they're home equities closed end. It's not to say that we don't do a lot of 1 to 4 residential. We do. That's the 25% as you kind of go at the bottom there. We have a lot of folks that own rental properties. Some of them own 2, some of them own 200. Some of them are fixer-uppers, holders. Some buy and flip. It's definitely a core piece of our business. At the bottom is construction at 8%. Those numbers haven't materially changed in dollars, but as the portfolio has grown, that percentage has gone down. But construction drives a lot of things in our portfolio. We have a lot of loans that start out as construction, will wind up in the 1 to 4, or start out as construction and go to the CRE portfolio. So I don't want to undercut the level of construction that we do. PPP at 1% at the end of the year. C&I at 9%. That's working capital lines, business vehicles, term loans. That goes hand in hand with the 20% CRE owner-occupied real estate. Great source of business checking, have the whole relationship. Somebody wants to own their building, have a working capital line, term loan, get all the accounts, full relationship. So that's a wonderful piece of our portfolio. Multifamily, commercial, other is really multifamily. Our multifamily is within an hour of our Exton location. It's only been recently that we've had some multi-story multifamily through some participations with our fellow community banks, but our typical multifamily is less than 30 units, an old house that got converted and maybe had a 2-story addition on the back of it. And then we go over to CRE, non-owner occupied at 19%. We don't really have a lot of the typical things. I think we have 1 shopping center and one hotel, but we do have an industrial slant. We operate in some areas that have become more infill. Outside storage and industrial zoning is really a big deal, and that portfolio has done very well for us on a non-ownerized basis. Let's go on to the next slide. We're looking at asset quality. You know, for a long time we did this slide, and I always thought we were a little bit behind the group, behind our peers. In 2008, we brought a chief credit officer in. We really started to focus on how we can improve those numbers. And when I say improve those numbers, I mean improve those numbers without creating a lot of charge-offs. It's easy to make your non-performing look better. You charge them off. We didn't want to do that. We classically have worked with borrowers to get to a good conclusion for us. I think this chart shows a wonderful conclusion to the point that I think we're actually a little better than our peer right now. Last 2 years, we've averaged 5 basis points in charge-off. And I'm proud to put this chart up because I wasn't maybe as proud as I wanted to be a couple of 3 years ago. All right, I'm going to hand it back to Lauren for balance sheet growth.
Great, thanks, Glenn. So back in 2011, total assets were $136 million, loans were $117 million, and deposits were $120 million. Now at December 31, 2021, 10 years later, total assets reached $469 million, loans were $388 million, and deposits were $400 million. Our growth over the past 2 years has been explosive, and internally we often remind ourselves that we're not the same bank we were 2 years ago. And this reminder makes us challenge ourselves in doing things differently without losing the little things that make us different. It's what I refer to as the secret sauce. Systems are evolving to keep up, as I mentioned earlier, and the enterprise workflow product is critical to maintaining our growth in an efficient way. We continue to invest in the bank to support our ongoing growth. We've had many years where loans outgrew deposits, and now that momentum has shifted, and we're working hard to keep funding loans to put our liquidity to work. And 26% loan growth last year shows the results of those efforts. While deposits are now growing faster than loans, those deposits are coming in a much more favorable mix towards checking. We are funding ourselves in the right way, a better way now. The growth on the loan side over the past 12 to 15 months has been replacing 1% PPP loans as they are forgiven with organic loans in the 4% plus yield range. These higher yields will result in higher profitability this year and in the future. Moving on to the next slide, balance sheet growth translates into top-line revenue growth, driven by significant growth in the loan portfolio and aided by the replacement of those 1% PPP loans into organic loans with higher yields. 26% loan growth last year positions us well for life after the Paycheck Protection Program. PPP fees were significant and will not be easy to replace, but 2021 loan growth will pay dividends in 2022 and beyond. Total interest income almost tripled from 2011 when it was just $6.7 million to 2021 when it reached $18.2 million. Moving on to the next slide, this one tells the story of how we've navigated rate hikes, rate drops, and flat rate environments over the years, and we've been able to maintain our margins no matter the rate environment. The green line shows the average Fed funds rate over the past 10 years, with the blue line showing the First Resource net interest margin and the red line showing the peer group average net interest margin. The historically high level of loans to assets that we maintain helps keep our margin strong, and strategically, we will always operate this way. We haven't always been able to secure the lowest cost deposits, but we've always been able to get the right asset pricing to not only maintain our spread, but also to consistently beat our peer group. Note that in 2011 to 2018, the peer group was Pennsylvania banks with $100 million to $300 million in assets for 2019 to 2021. The peer group from 2011 to 2018 was PA banks between $100 million and $300 million in assets, and then for 2019 to 2021, it was Pennsylvania banks between $100 million and $1 billion in assets. So even when comparing ourselves to much larger banks with significantly more resources at their disposal, we've managed to come out ahead of the peer group. So this next slide shows non-interest expense as a percentage of average assets. And the same peer grouping changes that I discussed on the last slide applies to this slide as well. Note that First Resource has consistently beaten the peer group in overhead expense control for the past decade. We were pleasantly surprised that we still beat the peer group when we compare First Resource Bank to much bigger banks. Working smarter, not harder, supports this overhead expense control goal. Investment in technology to be more efficient versus hiring more employees supports this goal as well. Having that mindset in everything we do is critical. Keeping our branch count low is key here. Using technology is certainly a far better investment of our time and capital at this time. So putting it all together on the next slide, all of these factors translate into net income growth. And we just completed our 11th consecutive year of increasing profitability. Net income for 2021 was $4.2 million, a 28% increase over the prior year. We accomplished this by growing the top line through growing loans, then funding those loans with low-cost checking accounts, resulting in a stable net interest margin. We strengthened our asset quality to minimize our provisions for loan losses, and we kept overhead as low as possible to allow maximum profitability to fall out as net income. The last 2 years' net income was aided by PPP fees, but we also took that increased income opportunity to do a few important things for our future. First is the core processing system conversion. We've already talked about that, but it's important to note here that all conversion costs are behind us. They were all included in 2021. Monthly fees going forward should not be that dissimilar to our costs on our old system, in part due to using a core contract provider negotiator. That engagement was worth every penny. We feel comfortable about our data processing costs going forward. Second, FHLB advances. For years, we had talked about the possibility of prepaying some higher rate FHLB advances, but we never had the earnings capacity to do so. We took advantage of the opportunity in 2021 to do just that. We prepaid $5.9 million in FHLB advances, carrying interest rates from 2.63 to 3.21%, and while incurring one-time penalties of $277,000 to do so, and that was all in 21, that $277,000 penalty, that will benefit us $384,000 over the next few years, with a significant benefit to be recognized in 2022. And third is the holding company project. We used our higher earnings capacity to start this project, which we'll discuss in detail on the next slide, but it's important to note that legal costs for a project like this were unappealing when we had lower levels of profitability. But the growth in income that we saw in 2020 and 2021 allowed us to take this next step in our corporate growth to start this project. We have talked about forming a holding company numerous times over the past 10 years, so it's great to get it started now. Moving on to the next slide, by far the most interesting thing we have going on regarding capital is the holding company. It will be named First Resource Bancorp, Inc. We have a shareholder vote on the approval of this restructure coming up at our annual shareholders meeting next month on April 27th. If you are a shareholder on the call, it is very important for you to vote on this matter, as we need 2/3 of our shareholders to vote to approve to effect the change. The vast majority of banks in the country already operate under a holding company structure, and we're excited for this opportunity to make this change, as it'll give us greater flexibility to raise capital in the future. Most notably, the option of raising debt at the holding company, which can then be downstream to the bank as common equity. This will allow us to support the bank's growth without diluting the common shareholder by having to issue new shares. Operating as a holding company also provides greater flexibility in operations and in potential M&A situations down the road. While we have no plans to do anything with the holding company right away, we want to make sure that we have all of those options available to us should the right opportunity present itself. And now I'm going to hand it back to Glenn.
Thank you, Lauren. So book value versus market value. I mean, we've said in prior slides, I can control the blue line, which is adding the book value through profitability. I can't always control the market, although the market was pretty good to us in the last 12 months and actually in the last week. This slide is based on 11:30 at the end of February, and yesterday the price was 11:55. We've had a couple of all-time highs with respect to the price when you factor in the dividend. So we're excited that the market's starting to recognize the value of the bank and our performance, and we'll continue to close that gap between market and book. We still think we're a bargain, and someone always told me to ask for the sale. So if you're not currently a First Resource Bank shareholder, please add a position to your portfolio. The next slide looks at the last 12 months, and this is nice. We're 33%. A lot of the banks have been in the indices are in the 7-8 range. I get that the S&Ps, had some good performance, but we generally compare ourselves to what's going on in the banking world. So this chart is only better from the time that we put it together to when we had to post these slides. So please think about buying some First Resource Bank stock. And Lauren's going to finish up with culture.
Yep, this next slide is called Culture is Everything, and we take culture really seriously. We firmly believe that happy employees translate into happy customers, and happy employees also translate into low employee turnover. It's a tough job market out there, and we firmly believe that treating your employees well right from the beginning is key to having low turnover. There's 3 best places to work logos on this slide. What we love about this is that it's an anonymous survey sent to all the employees. It really helps us gain valuable feedback on how to keep improving ourselves as an employer. We really want to be the premier employer in the region. And we were the only bank in the greater Philadelphia area that was named the best place to work by the Philadelphia Business Journal in all 3 years that we applied. And in 2021, we were actually named the best overall place to work in the medium-sized company category for all industries. Again, about culture, Glenn and I interview every prospective hire. So once they get through the HR and the management interviews, they sit down in the boardroom with the two of us, and we just talk. And we find that to have success here, it's 50% skills and 50% fit. We're very good at training bankers, but we really need to make sure that we have people that will embrace our culture and genuinely care about what we're doing here. Employees value the screening process, as we try really hard to not dilute the culture here as we continue to grow. We opened with 11 employees back in 2005, and we're up to 60 now, with the secret sauce still intact. The next slide is one of our favorites. The entire team is really proud of this award that we have now won for 5 consecutive years. We have a much smaller customer population than most banks we compete with in Chester County. Our customers are really engaged, and many are what we refer to as raving fans. The team gets very excited when this announcement comes out. Probably no one more excited than me, but nonetheless, it's a great source of pride for all of us. We've given all of our employees an extra day off when we've won this award each year, and it's been a fun motivator to challenge ourselves every day to deliver outstanding customer service. We currently have a TV ad campaign running, touting this 5-year legacy as the best bank in the area. And this next slide is best bank on the main line. So it's been great to see our notoriety of being the best replicate its way to the mainline area, as well as we were named the best bank on the main line for 2021 by our local paper there. So there's no better the search engine optimization than winning these awards. And when someone searches for a best bank, always having first resource rise to the top of that list. And also it's a great way to stay motivated, to stay at the top. So this next slide has our contact info, and we will be available for a few questions now, and then after the call, if you think of something, don't hesitate to reach out. Glenn, we got a few questions here. I'm going to get you started with one, okay?
Yep.
What have been the drivers of our loan growth, and do we see loan growth to continue at the same rate? You take that one?
Well, I think the drivers have been we've had our normal background business that we've done, but we've also we're going to get the benefit of an in-market merger with Bryn Mawr, and then we were seeing the benefit of a couple other in-market mergers a couple of years ago, pre-COVID. There's a core group of people out there that want to deal with a community bank, want to know a lender. They want to have a good experience. COVID taught us that people want to pick up the phone and talk to somebody about their business needs and their financing, and I think that we're in a great position to reap the benefits of some of this roll-up that's occurred in our market.
Great, thanks. Okay, so we have a question here that I'll take from Chip Russo. So what's our efficiency ratio? 64.6% for 21 was that number. We have another question here, Brad Ness, ROA and ROE. So for 2021, our ROE was 12.4% and our ROA was 92 basis points. So we have a question here from our friend Bob Rigg. How do we see rising interest rates affecting us? So I think the industry is in a better position to lag rates on the way up on the deposit side. I think the liquidity that we're all sitting on is going to give us a little bit more luxury than we've had in the past to lag rates on the way up. And we're certainly going to take advantage of every opportunity to do just that. And that's really where that checking growth insulates us, when we're less dependent on high cost or what we'll refer to as hot money. It just puts us in a different position than the last time rates were rising. So I think that's pretty much the questions we have in the queue here. So thanks for joining us today. And again, we're available for questions after the call. And it's been great. Thanks for joining us.
Thank you.